Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, June 28th, 2018. The markets are closed as I'm doing this video, so these are today's closing values. We're going to go over a few of the bond funds and a couple charts looking at interest rates real quick. For twofold. Number one, I do think and continue to think that bonds at this point in time make sense as part of a diversified portfolio, whether you're longer term investor, especially income investors, those more conservative. Typically the more conservative you are, the more money you want to have into safe money assets like government bonds. But then again, there are times where the stock market either goes down or doesn't produce returns, or can be very volatile, and that's where bonds can really help round out your portfolio. If one cylinder, meaning your stock portion, isn't firing, maybe another cylinder, in other words, your bond portion, commodities, gold, something else is at that time. And again, I like to use what I call tactical asset allocation. Go into these tactically, overweight, underweight, get out, even short bonds if I thought it was the right time, but it's not at this point in time. So let's go over the charts. And the other reason I wanted to do this as well is bonds can often tell you a lot about the stock market. Some of you out there might be saying, "Oh, bonds, that's what Treasury bonds. Those are what my grandmother buys." Along with their CDs. But again, there a lot of seasoned traders will look at bonds and different things like we'll get into here, such as credit spreads, a differential between investment grade or treasury bonds, safe money assets, and then junk bonds, the lowest quality bonds out there. So we'll look at that real quick. Let's start out with IEF. Since this is an active trade on the site, this video will be for members only. IEF is the 7 to 10 year Treasury bond ETF. So you're holding mid-range maturity Treasury bonds, US Treasury bonds, range all the way out to 30 years. Um, T-bills are your short-term bonds, and these are Treasury notes in that 7 to 10 year range. Just a technical term for the duration or maturity of these Treasuries. And then you have the long bonds, which are TLT, and we'll get to that in a second. So this one, as I've updated throughout this trade, we've had it on for a while. We entered this all the way back in early February at 102.30, but it keeps kicking us out dividends, pays us dividends from the interest it collects on the bonds. So therefore, those dividends effectively go to reduce our cost basis. So we're profitable on the trade. Again, as I said, Treasury bonds are not a get-rich-quick instrument unless you're leveraged up enough. I mean, they're some of the wealthiest traders out there, bond traders. You can trade bonds and via derivatives, leverage up because they're not as risky. You're not going to, drop 20% in a month like you will in or can in the stock market, when things get ugly. So keep that in mind again with your position sizing that due to the lower volatility, you can usually go a little heavier there. So with that being said, let's just dive into the charts. IEF was based on the largely based on this divergent low right here. You had positive divergence at the lows. That is and was still the stop, or still is, I should say, the stop on our trade. It hasn't been hit. This trade's profitable, as I mentioned. And again, there's two ways to adjust the cost basis. You can either reduce your entry price, or you can add it to where you went in at. I could have lowered these targets down, but I'll just leave them there for now. And it looks good. I don't want to spend too much time on it. You can see, essentially what we've had here is a breakout, a back test of that trend line, and we're starting to move higher. So that looks good. And these are the targets, and I may pull this one early depending on what I see. I'll leave these long-term targets on for now, but if something in the charts change, I may eliminate some of these targets and book profits at some of these other levels. And when I close a trade out, I usually share my thoughts, whether I think that might have more room to run, and therefore, longer term traders, investors can hold tight, or if I think there's a good chance you're going to get a trend reversal and give back a lot of the profits, then I'll make mention of that as well. So, and if I don't, just bump me in the trading room, and I'll be glad to share my thoughts. So that's IEF. That's looking at it on a daily chart here. Real quick, I'm going to pull up TLT, which is very similar, and I refer to this as a sister trade. We traded it back here as well, hit these targets. But I wanted you to note something here. Just look at in the last since about mid-May right here. Look at the climb that we've had in Treasury bonds. And again, these are bond prices. They work opposite to rates. When rates fall, Treasury bond prices go up. So you can see the trend has been up on TLT as well as IEF that I just talked about. And I have a point I'm trying to get to here. So mid-May, we've moved higher. We had that initial thrust up. This one's just like TLT. It's almost right about that previous thrust up. But now let's go to the other end of the spectrum real quick and look at junk bonds. Different story here. Since mid-May, you did get a thrust up, but we've sold off pretty sharply right now. And junk bonds are really testing this support level. If you look at that line I have there, you can see that they're tapping on support. It's around 35.50. If that level goes, that's going to be bearish. And now what this is, that differential that I just showed you with treasuries moving up and junk bonds moving down, that means credit spreads are widening. And these are some of the tells that professionals look at in the stock market to see if there's signs of if we're starting to see some cracks there. Now, yes, you tend to see junk bonds move in line with the stock market. So we have had a sell-off recently in the market, but look, today stocks were up and junk bonds were down again. So it shows you institutions are starting to get out of that. And if you're wondering why this all happens, junk bonds are typically those are your lowest grade bonds from corporations. And when times are good and profits are high and the economy's strong, default rates are very low. But once things start to slow down, you start to see default rates spike up. And again, this chart is, can also be a tell for the stock market. You can see there's that same support level right there. Just keep an eye on that. If you continue to see divergence between treasuries and junk bonds, meaning junk bonds fall, treasuries go up, or maybe treasuries continue to rally and or hold their own, let's say, and junk bonds move down, that could be a warning sign. So I'm not. I just want to make clear, I'm not bullish on junk bonds. They are at support. If you're looking for yield and you want to buy it at support, they kick out 5.61. It's off to the left of the chart. There's a dividend yield, but with a stop somewhat below. But I think this may go soon. That's at support levels. So that's just something I wanted to mention. And then also you can look at LQD, which is the investment grade corporate bonds. So these are companies, like, for example, Apple. They started selling bonds a few years ago, not because they needed the money. They were cash flush, just because they could, because the Fed had this ridiculous policy of keeping rates too low for too long. So most companies out there said, oh, what the hell? We can sell bonds at next to nothing. Turn around and use the proceeds to buy back our stock, and that's a large factor of what's juiced the market up to the levels that they're in right now. However, I wanted to point out that you can see here these investment grade corporates, they're back towards their lows as well. They're not rallying on this latest leg up with treasuries. So I think that's a potential, let's call it a yellow flag for the market and just something to monitor. There's some potential here in the chart if corporates can rally, if they can break out. They had a couple failed attempts above this trend line. There is a divergent low. They made another divergent low recently, but again, most in the last few weeks here, I'm seeing some divergence between the two. All right, back to treasuries, and we'll wrap this up. A couple things I wanted to mention. Okay, so here's TLT. And if you're trading bonds, the longer maturity on the bonds, if these are the same credit quality, which they are, treasuries, IEF, and TLT are both issued by the U.S. government, so that's a constant, the credit quality. The one difference is the maturity. So you have the longer the maturity, the more duration you have. Duration is a measurement of how much a bond will move in price with a given change in interest rates. So if you want, in other words, you want more bang for your buck, you go with the long-term treasury bonds, and it cuts both ways because they're more sensitive to changes in interest rates. If you get on the right side of a trend, you can make more money, and if you're on the wrong side of a trend, you can lose more money than you would on the shorter maturity bonds. Now, what stands out to me is, let me find a clean board and I'll point that out here. I've covered this in recent videos. There's this trading range here. You can box it in right here. And then you had this trading range right here. So we had a period where Treasury bonds broke out. That means yields drop, but now we're back into that box range. So this range on the left is comparable to this range right here. And I actually should draw that a little tighter. I'm being a little sloppy with these drawing tools here. Try to grab right around the high. Of course, I grabbed a circle tool, but I think you can see what I'm going for here is that range, and we're right at the top of that range. I also had that as a resistance level on my TLT chart a minute ago. So Now watch for a pop of this range. We're at resistance, so we're either going to pull back or break out soon. Could we trade there for a little while? Yes, but usually you can see get up to top of that range and usually pull back. And then once you break out, we had a breakout here with a little kick back into the range, but then that was it. And once we got above the top of that range, we remained above it. So this is a very well defined, this line here is a very well defined support and resistance level. It was resistance back here, support throughout most of 2017, and it has been resistance throughout 2018 so far since we fell back into that range. Therefore, the more tags you have on a level, the more important that level is. So if we do break out, maybe back test, maybe not, but you would expect a move probably back up to the top of this former trading range right here. So there's the potential for TLT. You can quantify it, in percentage terms. Top of that range is about 5%, but remember, it won't get there in a day. You're going to get paid to wait if you're in TLT. But again, we're right at resistance. So to take a position now, a long position, you'd be jumping the gun. Trading 101 says you either short to rally up into resistance, or if you're bullish and you think it's going to break out, you wait for a breakout above resistance. So there's TLT, and again, so, we're at that previous target, which I made mention too back here when we recycled into it, that these would be my targets again this time around. So we hit that target. Actually, we hit it back here too. Let's look at a couple other things and we'll wrap this video up. Let's look at interest rates now. So remember, you know, uh, the price of a bond is directly affected by interest rates. So when rates go up, the price of bonds go down and vice versa. So this chart here, TNX, is the 10-year Treasury yield. So this is our IEF trade in reverse. IEF, these are the rates that those bonds are paying. And so if you want IEF to go up, you want to see these go down. And you can see from the lines that I have drawn, we had a very clean, I like this trend line, a lot of reactions along it, clean uptrend line with a divergent high that formed a bullish rising bearish, bearish rising wedge, impulsive breakdown, back test. That's technical analysis 101. Doesn't get much better than that. Doesn't guarantee it's going to continue to play out, but the fact that the selling after the break of that trend line was impulsive helped to validate it. Then the fact that we came and back tested the trend line and then failed there gave that trend line additional validity as well as a pattern, and now we're moving lower. So based on this chart, my expectation is you can see a target I have here, 2616. I think we go down there. That's the yield, of course, 2.6 whatever on the Treasury 10-year, and yeah, that's about in yields about 7.5% or so drop. So that's the daily chart. We look at a weekly chart. This shows you a trend line, a breakdown there as well, divergent high. So this chart also indicates yields are going lower. And remember, that's contrary to what the public, or at least the masses, think with the Fed, especially what the Fed is telling us. They are on a rate hiking campaign. Now, they have hiked rates, but remember this. The Fed does not control long bond. They don't control the 10-year bond. They don't control the 30-year bond. They can try to manipulate it, and that's what they did with quantitative easing, buying copious amounts of bonds and doing all that stuff, but they cannot directly control the rates. Those are set, when the bonds are sold at auction, and then after the bonds are sold at auction, meaning new issues, they trade on the secondary market, supply and demand, just like a stock. The more buyers and sellers, the price is going to go up. The more sellers and buyers, the price will go down. The Fed does control the overnight lending rate. They control uber short interest rates, but therefore indirectly control rates. It permeates. If they put a zero interest rate policy, you're not going to have 10-year treasuries paying 12%. They're going to go down, but again, the market will control what these rates are paying, and I wanted to point that out, that this you can see that divergent high right there, negative divergence. That indicates we're going lower, just like you had. It's not all drawn out perfectly. I imagine that's just a line tool. You had negative divergence right here, and that marked this top. I can go back and forth. You had positive divergence right here. You can see there, and that marked that rally there. So this is it. Same stuff, same technical analysis that works on stocks and indexes tends to work very well on just about any security. And so this indicates, despite what the Fed is saying, And despite what the masses might think, that rates are probably going to go lower here for a while at least. And then we look back on a long-term chart, and this is a big picture. This spans back into the 70s, mid 70s. Um, and you can see this is the two white lines there. That's a long-term price channel. We've been in what they call a secular bear market in interest rates, meaning rates have gone down. This was the natural progression of that, and then this was the distortion. All this crap right here is what the Fed did with quantitative easing, the grand experiment. That was an unnatural pull down, if you will, of rates. But we're back, back on trend. And longer term, I think most people believe. I mean, we know there's nowhere but up for rates to go from where we got to recently. We were, a zero interest rate and interest rate policy. Yes, I know you can go to negative rates. They did that in some European countries, but there's a small floor under that. You go much below zero, which means people are putting their money in a bank and they're losing money. That doesn't work. You're not going to go down to a negative 3 or 4 or 5% interest rate policy. I can guarantee you that. But at that point, money will find its way into gold, cryptocurrency, go under the mattress, barter system. Nobody's going to put their money in a bank for negative 5% a year. So just think of zero effectively as a floor, is the point I'm trying to make there. And so rates now are going to do one of two things. They can come back down and revisit that floor. We can grind around for years. And that's, I think, probably the most likely scenario. I do think longer term, if we're looking out, 10, 15 years, sure, we'll embark on a new secular bull market in rates. But I think it could be a while here where we pound out a bottom, and there's plenty of downside, and to get back to where we were. So that's that. I just want to paint the bigger picture, what rates might look like and how it might affect the stock market, whether you're buying a house or plan to in the near future. I do think rates will come back in. That's my opinion now, based on the charts and also where I think we're at in the economic cycle as well. Mark my words, the Fed will backpedal on their plans to continue hiking if the stock market starts to really move down and we start to see economic data soften. So here's a TYX. This is a 30-year Treasury yield. And again, you just see, really pay attention to these trend lines. So as long as we're below trend, the rates are going to stay low, and we don't have to worry about sky high rates like some people talk about, hyperinflation, interest rates going to the moon. It's possible, but again, we're still well below trend, so we're still within that secular bear market that started back in the 70s here. And this chart does indicate over time we go higher. There were bullish divergences at the low, but we've already moved up. Rates have already moved up quite a bit. So let's get away from this and just go to, let's look at TLT like we did before. Here's the weekly chart. So a 10-year weekly chart of TLT. What stands out to me is this uptrend line right here. We broke down, back tested, but we also put in, as you can see here, there was a positive divergence right here as we hit support. These two lines here are what I call a support zone. So Treasury bonds so far found support there, and they did so by putting in a divergent low. You can see the positive divergences down here, just like we had negative divergence here at the high. So this says that we may continue to climb in TLT. That means rates down. Again, TLT are the bond prices. This is the instrument you trade. So if that's the case, maybe we come up, back test this trend line for a little while. Maybe we even regain it and head back up to that 128.65 level. If so, I think that's an objective place to book profits, or at least take a look at the time and see how things look. Maybe take profits, or possibly look to position for a breakout above that level. We'll just have to wait till we get there, but I wanted to show you that from a weekly perspective, and then the daily perspective, I think I already covered that. Yeah, we just have to watch for that breakout there. Yeah, that's pretty much it. The only thing I might mention, some of you probably thought about this, when you talk about Treasury bonds, is what we call the yield curve, and that's just the differential between short and long-term rates. And this is a 5-year Treasury yield here. So again, we're looking at interest rates. You can see 5-year yields hardly moved down at all recently. It did have a divergent high right here, but look at that compared to 10-year Treasury yields, which have fallen a little bit more, and more importantly, the 30-year, which has really come down. This shows you that the yield curve is flattening Longer term rates are falling while shorter term rates are going up. Why is that? Well, the Fed has been hiking and they're keeping that short term rate is, the 5-year treasury is going to stay up at a certain range, even though the Fed doesn't control it directly, but they are controlling the short end of the yield curve. But they can't control the long end. The long end is priced in by, investors and really the smart money as to where they think the economic growth is going to be in the future. And by yields coming down, that is indicating or telling you that market participants see growth slowing. And that's why the long bond's dropping right now. And that's why, you get a yield curve, it flattens out. And then if you go to an inverted yield curve, I don't know the statistics offhand, but I believe it's every one of the past X number of recessions, and it goes back quite a ways, and bear markets, they were all preceded by an inverted yield curve. So I have to check it. I do have a different link to the Treasury, US Treasury site, um, and it'll show. I'm pretty sure we haven't inverted yet. You'd hear about it, but we are flattening, and that's what that shows you here. All right, let's wrap it up there. This has been Randy Finney with Right Side of the Chart. Hope you found it useful.